Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. You cannot turn on a TV station over the weekend without hearing about global supply chain issues, without hearing about inflation, the everything shortage that we are faced with here in this time and place in 2021, 18 months into this pandemic. It continues. If you look at the FOMC minutes, last week, transitory 4 times, inflation over 75 times. BOE Governor Bailey over the weekend saying it's likely the BOE will have to move here. We've highlighted that, really the price action that has spilled over into the U.S. market, particularly on the short end since the September FOMC meeting. Central banks are not going to solve supply chain issues here, but the fear is spreading inflation. We're hearing that from members of the Fed, like Atlanta Fed President Bostic, others on Friday. The Fed explicitly pointing in their minutes to the shelter component, owner's equivalent rent and CPI, 30% of that index now. Fear of spreading and growing inflation, the BOE inflation expectations, this notion, these dynamics of what we're seeing now becoming more entrenched, more embedded in the consumer's mind moving forward. That is the fear. So it's not just words, it's actions. We now have 2 full rate increases priced into the U.S. market for 2022. We write about this in our weekly piece, whether that comes to fruition or not. And when we look at the FOMC timeline that they've laid out in the minutes, if they do taper in November and actually start the taper with that mid-November New York Fed schedule, 8 months, $15 billion a month, certainly takes us in a linear fashion. They could move slower or faster in a linear fashion into mid-2022. You know, they're telling us taper, then lift off, and there's likely to be some time in between there. So it seems unlikely we get 2 rate increases in 2022, but we've seen this before. I mean, market participants that have been around a long time, we've seen the market price in what it wants to price in given the current dynamics, and then how that plays out, whether or not that comes to fruition, what inflation looks like as we roll into 2021 and get closer to those dates will determine how the market restructures and reprices. But very similar in some ways to the beginning of 2021, the mini tantrum, the extreme bearishness with the economy reopening, with vaccinations, with a lot of treasury supply. We saw that bearishness in the belly of the curve, in the 7-year part of the curve. We saw that certainly in changing in Fed expectations. The difference now, however, is that transitory narrative, which was really alive and well at the beginning in the first half of 2021, is fading very, very quickly here as we approach the latter part of 2021 into 2022. Vice Chair Clarida, the inflation expert on the Fed, told us explicitly months ago, when will you know we're wrong? And he said it would be right around this time, 21 into 22. So the market pricing in some rate increases in 2022, in our opinion, whether you agree with it or not, is certainly not inappropriate given all that we've seen here short term from global central banks. 162, the upper end of our range in 10-year UST. If we do continue to find bearishness further in the curve in the 5-year, it's likely at some point we test and break through those levels for a move back toward the upper end of 2021, which takes us up toward 175, 178. I think through those levels, certainly global markets, risk assets in particular, will certainly perk up. On the ground this week, we do get economic data, a ton of data on the housing side with rate levels moving up here, refi slowing, all focused now on home inventories and sales as we head into 2022. On the supply side, we expect more supply on the corporate side. Certainly, we will get a 20-year auction in U.S. Treasuries. And with regard to the Fed, more Fed speak this week, capped off by the chairman himself at the end of this week, ahead of the Fed's blackout period for the November meeting. Wishing everyone a great week. I'm Greg Faranello, head of U.S. rates for Amerivet Securities.